So, you found this great dividend stock. It was recommended by someone on Facebook, a friend, a coworker, or whatever. But does it actually fit your personal goals, current portfolio, risk profile, and financial situation? In this video, you will learn why it is a mistake to buy dividend stocks based on a recommendation without taking your personal situation into account. Hi, I'm Tom from the Dividend Attitude. If you are a regular watcher of my videos, then you probably realize that today's topic is a bit different than my normal in-depth analysis videos on dividend stocks. But don't worry, those will be coming soon again as well. If you are new to the channel, welcome and enjoy the video. I will use much of my personal situation to show you how I go about deciding whether a stock fits in my portfolio based on my goals, my investing philosophy, my risk profile, my financial situation, my years to retirement, and my current portfolio. A stock I recently analyzed is IBM, but you can insert similar stocks here that are on the higher side of the dividend yield spectrum, like AT&T, AbbVie, and ExxonMobil, for example. But there are also different stocks like Apple, Microsoft, Lowe's, NextEra Energy, Visa, and so on, with much lower yields. Purely based on the dividend yield, you could argue that IBM and the other high-yield stocks would be the better investment, because they give you a better immediate return for your invested money. And this is where a lot of the discussion surrounding different stocks comes from, because a good stock does not necessarily mean it is a good stock for you. Let me start with goals. Tesla, Amazon and Disney are all great companies, but they don't fit my goal because they don't pay a dividend. Austria, ticker MO, it is a dividend stock that has a place in many portfolios, but not in mine. Why? Because I think the cigarette industry will keep facing headwinds and I'm not convinced Austria will be able to diversify enough to overcome that. If you own Austria, this probably already sparks emotion. Do you see how this works? It might fit for your portfolio, but not mine, because investing is personal. Because some of my personal dividend investing goals are generating a passive income stream of at least 30k per year, I buy and hold stocks for the long term, 10 plus years, a portfolio of about 25 to 30 stocks for sufficient diversification, organic dividend growth of at least 5%, portfolio-wide, creating generational wealth. Goals are important because they will help you give direction and guidance on your investing journey. From this, I can already eliminate stocks that don't pay a dividend, Tesla, Amazon, etc. Stocks that are in declining industries, GameStop, Altria, etc. are not raising their dividends regularly, Disney, right now. Like the video so far, hit that like button and make it turn blue. Also, consider subscribing if you want to stay updated on future content, like in-depth company analysis, portfolio updates and motivation on your dividend investing journey. I'm right there with you. My investment philosophy is intertwined with my goals. I prefer dividend stocks with a healthy return on equity, growing revenue, growing earnings per share, growing cash flow and low debt. I also prefer companies with a starting yield of at least 3% and a minimum of 5% dividend growth annually. Capital appreciation is not my first concern. Growing dividend income is, but I still want as much bang for my buck as possible, so I buy unvalued dividend stocks. Going back to the stocks I mentioned above, let's pick IBM and Microsoft. IBM is again a stock in many portfolios, but not in mine. The same applies to AT&T, a highly debated stock that has a place in many different portfolios, but again, not in mine. Why? IBM and AT&T both have a somewhat high initial yield of nearing 6 and 8%, but their recent dividend growth rates are well below the 5% I'm looking for. These stocks would probably be ideal for retired or near retired investors, because they require immediate dividend income, and I'm far off traditional retirement. More on that in a bit. Microsoft would fit my philosophy because they are a growing, healthy company, but they currently don't fit my goals in a vacuum because of their low starting yield. I will explain in a bit how Microsoft could still end up in my portfolio despite not meeting their 3% initial yield. Another important determinant to understand if a particular dividend stock fits in with your personal preferences is your risk profile. I rate it from 1 to 10, the latter being the most tolerant. Don't overestimate this. Can you handle a 20, 30 or even 50% downturn in your portfolio after you have carefully crafted it for 5 years, even if it takes 3 years to recover? If the answer is no, you probably want to keep your risk profile below 5. This determines your asset allocation. This is important because there are two types of risk: systematic and unsystematic risk. Systematic risk are risk factors beyond the control of the company, such as economic, political changes or other factors such as the current health crisis. Every investment bears risk. You can reduce risk by proper asset allocation, portfolio beta, etc. Unsystematic risk is the risk of specific industries or companies getting into trouble. For dividend stocks, this can be reduced by the number of stocks you own. After 25 to 30 stocks, there's a very minimal risk reduction, so that is the sweet spot when it comes to reducing unsystematic risk. I also made a separate episode on risk and diversification, which is now suggested in the top right. Back to the point of the video. Why does your risk profile influence which dividend stocks suit you and which ones do not? Take Tanger Factory Outlets, ticker SKT, which I own in my portfolio. The current beta of SKT is 1.78. Meaning it is 78% more volatile than the overall market. Beta measures the volatility of a stock compared to the overall market. If your risk tolerance is low and your current portfolio beta is already above 1, you probably do not want to own this stock. My portfolio is at 1.01 including SKT, and I know for a fact that my risk tolerance is very high from real experience. I've mentioned this a few times, but I will reiterate it again. I was a professional poker player a while ago, meaning that losing or winning $1,000 in a day was not uncommon. So I know how I react in those circumstances. If you don't, it is better to keep your risk tolerance estimate lower. And then your financial situation. This is both your current and future financial situation. Will you also get social security or other forms of income? What kind of companies you purchase also depends on your current and future financial situation. Will you have more income streams when you retire than just the dividends? In other words, can you afford to wait for dividends to grow, or do you need the dividend income straight away? One of the bigger influences of the stocks you pick is how many years to retirement you have. But years to retirement is not everything. You see, one of my goals is to create generational wealth. So even if I would be near retirement, I'm not, I might want some lower yielding stocks with higher dividend growth in my portfolio to compensate for that. Back to AT&T, IBM and perhaps stocks like ExxonMobil. These are all higher yielding stocks, but these are also stocks with lower dividend growth. For someone younger, like me, this doesn't make sense in a vacuum. But if you're nearing retirement and you need stable and direct dividend income, these stocks would probably make a lot more sense. It could make more sense if I want to balance my portfolio with some current dividend income if I already have a lot of lower yielding, faster dividend growing companies. Again, this depends on your goals as well. By now you might be wondering, okay, if I should not take recommendations from others, how do I find the stocks that fit my goals, philosophy, age and so on? I've previously made a video on how to find and analyze dividend stocks, so be sure to check that one out. You can click on it here in the top right corner. Then there are also the lower yielding stocks with higher dividend growth like Microsoft, Apple, Visa and so on. In a vacuum, these stocks would not fit my goals. For example, the minimum of 3% dividend yield, but would fit my years to retirement. However, again, they could make sense if they are balanced in a portfolio which already has a higher current yield but is lacking dividend growth. Long term, when the opportunity arises, I will pick up one or more of these lower yielding stocks. But if you're nearing retirement, again in a vacuum, it wouldn't make sense to own these lower yielding stocks. Unless, like me, you plan to create generational wealth. And don't forget, with the prolonged longevity of life, you could live another 30 years after retirement. Meaning there would be plenty of time for stocks like Apple, Microsoft and Visa to generate sufficient dividend income for you. And lastly, your current portfolio. Which stock you already have in your portfolio determines whether a certain stock would fit in your current portfolio. I am talking about how diversified you are already and if your portfolio beta is at your desired level. For example, my current portfolio beta is 1.01. I don't want to go much higher than that and preferably lower than 1. Take Apple, a great company which I probably would like to own, but with a beta of 1.31, it would bring up my portfolio beta above desired levels. What is your current portfolio beta? And how would Apple fit in your portfolio based on that? So I'm not saying I don't want to own Apple when the opportunity presents itself, but I would have to purchase another company with a low beta to compensate for that, to bring my portfolio beta down. Typically, utilities are less correlated with the overall market, thus they have a lower beta. So that would be an option. I hope this episode got you to think about your purchases through a different lens. Not only the quality of the company matters, it matters just as much if it fits you and your situation. If you enjoyed this video and would like more content like this, be sure to let me know in the comments below. Also, consider subscribing if you want to learn more on how to do in-depth analysis of dividend stocks. Until next time, bye bye.